Saving. Saving refers to the act of. Saving can take many forms, including putting money into a savings account, investing in stocks or bonds, contributing to a retirement account such as an IRA or KEY, or simply setting aside cash in a jar or envelope. The benefits of saving include the ability to weather unexpected financial emergencies, achieving long-term financial goals, and reducing financial stress and anxiety. However, saving requires discipline and sacrifice, as it often means choosing to forego immediate gratification in favor of future security or goals. A savings account is a type of bank account that is designed for the purpose of saving money. It is a secure and accessible way to store and accumulate funds while earning interest on the balance. Savings accounts are typically offered by banks, credit unions, and other financial institutions. They generally require a low minimum deposit and may have restrictions on the number of withdrawals or transactions allowed per month. In exchange for these restrictions, savings accounts typically offer a higher interest. The interest rate on a savings account can vary depending on the financial institution, the amount of money deposited, and the prevailing market conditions. Some savings accounts offer tiered interest rates, where the rate increases as the account balance grows. Savings accounts are a good option for short-term financial goals or emergency funds, as they provide a safe place to store money while earning interest. However, they may not offer the highest returns on investment and may not keep pace with inflation over the long term. For longer-term goals, such as retirement savings, investing refers to the act of using money or other resources to acquire an asset with the expectation of generating income or profit in the future. Investing can take many forms, including buying stocks, bonds, mutual funds, real estate, commodities, or other assets. The primary goal of investing is to generate returns that exceed the rate of inflation, thereby preserving or increasing the purchasing power of one's wealth. Investors may also seek to achieve specific financial goals, such as funding retirement or saving for a child's education. Investing involves taking risks, as there is no guarantee that the value of an asset will appreciate or that a particular investment will perform as expected. To mitigate risk, investors may diversify their portfolio by investing in a variety of assets or by using other strategies such as dollar-cost averaging or value investing. Investing requires a long-term perspective and a willingness to ride out market fluctuations and downturns. Investors must also be prepared to conduct research, monitor their investments, and adjust their portfolio as necessary based on market conditions and their own financial goals and risk tolerance. Overall, investing can be a powerful tool for building wealth over time, but it requires discipline, patience, and a willingness to take calculated risks. Stocks, also known as shares or equities, represent ownership in a publicly traded company. When an individual or entity buys stock in a company, they become a shareholder and are entitled to a portion of the company's profits in the form of dividends, as well as the right to vote on certain company decisions. Stocks are traded on stock exchanges such as the New York Stock Exchange or Nasdaq, and their prices are determined by supply and demand. When more investors want to buy a particular stock than there are sellers, the price of the stock goes up. Conversely, when more investors want to sell a particular stock than there are buyers, the price of the stock goes down. Investing in stocks can be a way to build wealth over time, as stocks historically have generated higher returns than other asset classes such as bonds or real estate. However, stocks are also subject to volatility and risk, and their value can fluctuate widely in response to economic conditions, company performance, or other factors. To invest in stocks, an individual or entity typically opens a brokerage account with a brokerage firm or online brokerage platform. They can then buy and sell stocks through the brokerage, often paying a commission or fee for each transaction. Overall, investing in stocks can be a way to participate in the growth and success of publicly traded companies, but it requires research, patience, and a willingness to accept some level of risk. Bonds are a type of fixed-income investment that represent a loan from an investor to a borrower, typically a corporation or government entity. When an individual or entity buys a bond, they are effectively lending money to the issuer in exchange for regular interest payments and the return of their principal investment at the bond's maturity date. Bonds are typically issued with a fixed interest rate and a set maturity date, which can range from a few months to several decades. The interest rate on a bond is determined by a number of factors, including the creditworthiness of the issuer, prevailing market conditions, and the time to maturity. Bonds are generally considered to be less risky than stocks, as their returns are fixed and predictable, and they are often backed by the creditworthiness of the issuer. However, bonds are still subject to risk, particularly if the issuer defaults on its payments or if inflation erodes the value of the bond's future cash flows. Bonds can be purchased through a brokerage account or directly from the issuer, and they can be traded on bond markets. Some common types of bonds include government bonds, municipal bonds, corporate bonds, and treasury bonds. Overall, investing in bonds can be a way to generate regular income and diversify one's investment portfolio. However, like all investments, bonds require careful consideration and analysis to determine their suitability for an individual's financial goals and risk tolerance.